So about a month ago, I've released a 40-minute long video with the video title, I reviewed every company in my negative 9.28% portfolio, brackets, after 2.5 years. And yes, I was essentially stripped naked in front of the internet where I reviewed every single position of my portfolio, how many shares I have, what was my cost basis, and more importantly, what was the absolute dollar gain or dollar loss on every single position. And for those of you who have followed, the negative 9.28% was essentially a simple return of the portfolio after contributing diligently for 2.5 years. I essentially took the value of the portfolio divided by the amount that I've put into it. I'm happy to announce that after 1 month, at the end of July, 28th of July to be exact, I'm currently sitting at a royal 1.59% gain. But I'm extremely scared of how the market is going to turn out. So once again, I would like to thank all of you who have followed me onto this journey. I'm probably going to liquidate when the market opens on Monday, and I'm walking away from this entire stock investing shenanigans. And I probably cannot take the volatility anymore. I'm happy that I broke even after 2.5 years. So of course the opening was a joke. I live and breathe the stock market and I love investing. It's essentially like a game. I'm like a child in the playground. But anyhow, I really just wanted to walk through what essentially transpired, what was my investment strategy and opportunity, and why I'm scared of the stock market today. And more importantly, what I'm going to do. And just a bonus factor of a very recent discussion that I had with a friend on what exactly is my exit strategy. So I think to go back to the basics, for those of you who didn't watch the video, I highly encourage you to do so. It essentially outlines my thoughts around every single company that I hold in my portfolio today. But to really scroll back down and to understand what kind of investment strategy or philosophy that I'm currently adopting, these are mainly the broad-based principles that I do adopt. So first and foremost, I do invest in fairly matured companies, companies with pretty large market cap. You probably wouldn't see me investing in those micro caps or small caps. And I do understand that, or at least I feel that the sweet spot for growth for many of these mature companies is I still want to look for some sort of growth and opportunities for me to realize some sort of value from the operating efficiencies and how the companies are going to return many of this capital back to shareholder. So the sweet spot for growth is around 8 to 12%. Valuations need to be attractive for me to enter into a position. The company needs to be dominant. They are leaders in their own domains and space. And all of them are probably have taken a beating. They are down 30, 40, 50% from its all-time highs. And to really understand on what essentially transpired compared to the start of the month and the end of the month, why is there such a huge delta where you add 9.28% and 1.59%, that's a delta of around 10 to 11%. I don't necessarily think that this is alpha generated by the portfolio. It's really just because the market is extremely volatile. Many of these names, particularly so my bigger positions like Alibaba, Tencent, they are rallying by quite a fair bit over the last 30 days, which is why there is such a huge movement in my portfolio. And if you haven't realized already, in terms of the percentage of the portfolio, just looking at the top 4 positions, it's 80%. And surprise, surprise, the top 4 positions, they're all Chinese-based names. Alibaba, Tencent, Chinese big tech, Chinese banks, and more importantly, KWEB, which is an ETF, which consists of or comprises of your big tech names back in China. So you can see that I have a huge tilt and huge bias towards the Chinese companies and many of these Chinese tech names. So essentially, I'm going to explain briefly on why I'm currently scared of the entire markets today. So this is definitely anecdotal. As you guys might know, I actually do follow a lot of other fellow creators on multiple platforms, whether it's on Twitter, on YouTube, on Facebook, whatever. And you can see that there is this newfound love and newfound excitement around many retail investors. And they are saying that, oh, I managed to beat the market. My year-to-date returns are 30, 40, some are even hundreds of percents. And for many of those that have the hundreds of percents in returns over the last 7 months or so, they are probably doing one of two things. First thing is they leverage, whether is it with options or just buying on margin. Or number two, they have a huge concentration in some of these names that had a huge run, like maybe Tesla, Meta, Nvidia, and stuff like that. So I think I really just wanted to go back down to the fundamentals and basics of investing And I believe that most of you are probably aware of this psychology of the market cycle. Maybe just leave in the comment section down below which part of the cycle do you think we are at. Currently, I do think that we are in the belief/thrill cycle. I don't necessarily think that the stock market, or at least the broad-based market, is in a bubble. I don't think so. But I do feel, at least, like I said, this is anecdotal. I do feel there's this newborn excitement and people are getting excited. It might be a little bit frothy, but I do not expect the market bubble to burst, or I would not even argue that the market is in a bubble today. Yes, they are probably in a fair value or slightly overvalued territory. If you were to look at many of these main benchmarks, whether is it a PE ratio, look at the S&P 500. But I do feel like there is still opportunities in the market, especially so if you are able to understand and study the fundamentals of the company. I still do think that there are opportunities and companies that might be undervalued or even fairly valued that might still be able to reap rewards and yields for investors that know how to identify them. So that's why, at least for now, in terms of how I understand it, it doesn't really matter because, like I said, 80% of my portfolio, it's tilted to the Chinese market. Whatever Meta, whatever Amazon wants to do, yes, they do have a position. I'm sitting on great gains, but I don't intend to realize them unless it's probably egregiously overvalued. But right now, I do feel like it's moving in tandem, sure. But yeah, the Chinese market is probably moving in their own footstep. I think for people that have followed me, many of you are also Alibaba investors. You guys probably all have your own investment strategy or philosophy. I do feel like everybody should still stick to their guns and to maybe review and revise on what they've done thus far. What have went well, what have not went well, and just do like a quarterly update and to really understand how to improve your overall investing framework. So more importantly, I believe in the quote where don't listen to what the person is saying, look at what he's doing. And just by a very brief understanding and outlook of my portfolio, I have more than 80-85% allocated to China, and I've been constantly touting or constantly talking about the bottoming of many of these Chinese names, Hong Kong names. I do still feel like there is a great opportunity from a risk-reward perspective from many of these Chinese names. Of course, if you're uncomfortable, please don't come near them. But yes, I still remain extremely bullish and I'm putting money where my mouth is at. And just on a relative basis, many of these Chinese names are still severely undervalued when you compare to their big tech or US counterparts. And also, you can tell that I started allocating more money into Singapore REITs. So that is also another pocket of opportunity that I would like to explore. So like I said, don't look at what the person is saying, look at what the person is doing. So on the last part where I had an interesting conversation with a friend recently, he essentially texted me, I see you are very resistant in selling anything in your portfolio. But as you gain more experience in market and life, you will understand the code of whether you want to be a real genius or you want everyone to think that you are a genius, making the best decision or having a portfolio look good. And I kind of understand where it's coming from. Essentially, it's your exit strategy on many of your portfolio positions. And I did actually get a few questions, particularly so regarding my Meta platforms. Many people are asking, hey, when are you going to take profits? Or even for Alibaba in this case, where Alibaba is currently rallying back up. And they're asking, oh, do you have a exit price or exit multiple for Alibaba? Maybe when it's 120, 150, 180, are you going to take profits and slowly exit out of your position? I think to me now, it really boils down to your investing framework and how you look at this entire game of investing. So I'm just going to lay it out straight. I think with my own investing methodology, I will always be fighting against the mainstream because like I suggested in the earlier part of the video, so one of the key criteria that I'll start a position is when the stock is kind of beaten down. And when the stock is beaten down, usually the narrative around the positions are not good. Everybody going to say that this basket of stocks or XYZ company, it's uninvestable, the growth is essentially gone. You can throw in all the negative sentiments around it. I do believe that narrative follow the stock price. So the lower the stock price go, the more people will talk about the companies in a very bad light or portray them in a very bad light. And on the flip side, when the stock rallies, people get excited again. And which is why right now, I do understand that many people are starting to plan for their exit strategy. Or in fact, some people have already exited on many of their positions. I think when Meta, a lot of people entered at 120 to 150, and when it's 200 to 240, everybody exited. And some people are regretting, some people are saying that, oh, I've already established that stop loss, I've established that exit prices. So I don't necessarily think that there is a correct way to invest. Whether you want to set an exit multiple or whether you want to set an exit price, it's entirely up to you. But for me, I really sell on probably two main conditions. Firstly, when it gets egregiously overvalued. So I think doing a valuation exercise on most of or all of your counters every quarter or every six months or so, it's necessary because it gives you a kind of litmus test to really understand whether you're still keeping a pulse on in terms of the numbers and the valuations of the company today, and also to kind of update yourself in terms of your worldview and how the company is performing on an operating level, on what kind of cash flow they are bringing in to shareholders. That's generally it. So unless the company is egregiously overvalued to a point where I can't fathom a scenario where the company is able to still deliver returns at that kind of valuation, that's when I would exit. And on the second point is really when the thesis doesn't play out. So I think one of the main contentious company that I hold in my portfolio is really Alibaba and Tencent. So a lot of people are saying that, oh, you have been holding onto this loser for 2 years, 2.5 years. And I've been often ridiculed by even friends. People that haven't seen me for some time, the first thing that they see me is, hey, how's Alibaba doing? I mean, I got kind of used to it. But really, the entire idea, the entire thesis of Baba was really in terms of mean reversion for multiples, earnings revision, and really the ending of tech crackdown and essentially just the government loosening their policies and basically allowing for these companies to flourish again. So all these are in way, and a lot of people like to ask me to put a timeline. Oh, if you don't see it playing out in 6 months, in 1 year, are you going to exit? Are you going to start reallocating your capital? Let's not forget about opportunity costs and stuff like that. I think it's a very fluid topic. There really isn't a way for you to say that, oh, within 1 year, if I don't see results, I'm going to exit my position. Because we all know, I'm not going to name names, but we all know many successful companies that probably had a loss 5 years or a decade or so, continue on to have a great rise in the subsequent 3-5 years later. So it is a pity for those of you who have entered and then exited and then the company continue on to have a good run. I'm not going to say that, I'm not going to plant my flag and say, be cocksure and say that, oh, Meta is going to be that company that experienced from 300 to 100 and then it's going to climb to $500-$600. I don't know. Your guess is as good as mine. But unless there's really something fundamentally wrong with Meta going forward, or if it's egregiously overvalued, that's when I'll sell. If not, I'm just going to sit tight, just look at how things are playing out and just enjoy the show. I've backed my capital in some of the names that I have high conviction in, and I'll just look at how it will play out. In terms of tech regulations, in terms of the government supporting the economy, whether China is going to recover, whether the consumption is going to come back, it's a work in progress, and I'll keep a close eye to many of this positioning. So that's just generally how I look at my exit strategy and my investing framework. So I'm happy to engage in a conversation with you guys. If you guys have a differing opinion, in the comment section down below. If not, at least for myself, I still see a huge potential in terms of many of these Hong Kong stocks and Hong Kong counters, still extremely undervalued. A lot of upside, risk-reward perspective. I love it. With that, I'll see you in the next video. But more importantly, I will finally see you on the moon. Goodbye.